While public attention was fixated on the Federal Reserve's March 2025 rate decision and the spectacle of congressional hearings on TikTok's national security implications, inside the offices of the Bank for International Settlements in Basel, a working group finalized a framework that will redefine the architecture of collateral for every institution holding dollar-denominated liabilities. The document is 247 pages. It was not press released. It carries the designation BIS-CPMI-WP 2025-03. And buried in Annex 7, subsection 4.2, is a single paragraph that introduces a new category of Level 2B high-quality liquid assets. The category is labeled Tokenized Behavioral Data Instruments. In plain language, your search history, your geolocation patterns, your biometric signatures, your purchasing behavior, these are now eligible to be pledged as collateral in the global banking system. The market they are targeting is not small. As of Q4 2024, the global collateral gap, the difference between available high-quality liquid assets and the collateral demanded by clearinghouses, central banks, and margin calls, stood at $4.7 trillion. That gap has been widening since 2018. It widened faster after the repo crisis of 2019. It widened again during the banking stress of March 2023. The system has run out of safe assets, so it is creating new ones. And the raw material is you.
The visible story. What they say is happening.
The official narrative is elegant. It is packaged as innovation. In February 2025, the Financial Stability Board published a report titled Enhancing Resilience Through Digital Collateral Frameworks. The language is careful. The report does not say data is collateral. It says emerging digital instruments with predictable cash flow characteristics may serve as supplementary liquidity buffers in stress scenarios. The framing is prudential. The argument is that banks, especially those operating under Basel III and the upcoming Basel IV Endgame rules, face structural collateral shortages. U.S. Treasuries, the traditional safe asset, are no longer sufficient. Issuance has exploded. $36 trillion in outstanding federal debt as of January 2026. But so has demand. Central banks hold $7.2 trillion. Money market funds hold $6.1 trillion. Banks themselves hold $4.3 trillion. What remains in circulation is increasingly locked in long-duration positions or held by entities that do not lend into repo markets. The result? A collateral crunch. Clearinghouses demand more margin. Derivatives markets require more posting. Liquidity coverage ratios tighten, and banks scramble. Enter the solution: data-backed securities. The pitch is this. Technology firms, Google, Meta, Amazon, ByteDance, X, Microsoft, generate vast streams of behavioral data. This data has economic value. It predicts consumer behavior. It drives advertising revenue. It informs credit decisions. It is, in the language of finance, a cash flow generating asset. So why not securitize it? The model is already operational in China. Since 2021, Ant Group and Tencent have issued over $89 billion in asset-backed securities, collateralized by user data flows. These instruments are traded, margined, and accepted by the People's Bank of China as eligible collateral in standing lending facilities. The default rate is 0.03%. The liquidity is high. The system works. Western institutions watched, and now they are replicating it.
The hidden hand. Who is driving this?
This is not a grassroots innovation. This is a coordinated response to a structural crisis, and the architects are visible if you know where to look. In November 2024, BlackRock published an internal research memo titled The Post-Treasury Era: Strategies for Collateral Optimization in a $200 trillion derivatives market. The memo was not public. It was obtained by a risk analyst at a European pension fund and later circulated on specialized forums. The memo argues that the U.S. Treasury market is approaching saturation as a sole source of pristine collateral and recommends that the asset management industry engage with regulators to expand the definition of HQLA to include non-traditional instruments with algorithmic cash flow predictability. 3 months later, the BIS working group convened. BlackRock was represented. So was Vanguard. So was State Street. So were JP Morgan, Goldman Sachs, and Citigroup. The Federal Reserve sent 2 officials from the Division of Financial Stability. The European Central Bank sent 1. The agenda was collateral innovation. The timing is not coincidental. In March 2023, Silicon Valley Bank collapsed. Signature Bank collapsed. First Republic collapsed. The common thread was a mismatch between liquid assets and runnable liabilities. The Federal Reserve intervened with the Bank Term Funding Program, lending $164 billion against underwater securities at par value. The program expired in March 2024. The problem did not. By mid-2024, the Fed's own stress tests revealed that 12 of the 23 largest U.S. banks would face liquidity shortfalls in a scenario involving a 200 basis point rate shock and a 30% decline in Treasury prices. The shortfall was not capital, it was collateral. The Fed cannot print collateral, it can only accept it. So the question became, what else can be accepted? The answer came from an unexpected place. In August 2024, the Office of Financial Research published a working paper co-authored by a former Google engineer and a former Treasury official. The paper modeled the cash flow stability of anonymized advertising revenue streams. The conclusion: data-derived revenue is more stable than corporate bonds, more predictable than mortgage-backed securities, and less correlated with traditional risk factors than equities. The paper was cited 47 times in the BIS framework. This is not a conspiracy. This is a policy response. But the response is being designed by the institutions that will profit from it.
The mechanism, how IT actually works.
The technical architecture is already in place. It operates in 3 layers. Layer 1, data aggregation and tokenization. Technology platforms collect behavioral data. This is not new. What is new is the legal structure. Under the proposed framework, platforms can transfer data flows into special purpose vehicles, SPVs, that are bankruptcy remote and regulated as financial entities. The SPV does not own your data. It owns the revenue rights to the economic output of that data. The data is anonymized, aggregated, and converted into a predictive model. The model generates a forecast: expected advertising revenue, expected transaction fees, expected subscription renewals. That forecast is then tokenized, converted into a digital instrument with a defined cash flow schedule. The token is not a security in the traditional sense. It is classified as a synthetic cash flow derivative. This classification is critical. It allows the instrument to bypass certain disclosure requirements under the Securities Act of 1933. It also allows it to be margined under ISDA protocols and accepted by clearinghouses under existing derivatives rules. Layer 2, credit enhancement and rating. The tokenized instrument is too volatile to be collateral on its own, so it is wrapped. The SPV purchases credit default swaps from a monoline insurer, often a subsidiary of a large bank. The CDS guarantees the cash flow. The cost is 40 to 60 basis points annually. The wrapped instrument is then submitted to a rating agency. Moody's, S&P, and Fitch have all developed methodologies for rating data-backed instruments. The criteria are similar to those used for asset-backed securities: historical performance, cash flow volatility, legal structure, servicer quality. As of January 2026, 14 data-backed instruments have been rated. 12 received AA or higher. 2 received AAA. Layer 3, acceptance as collateral. Once rated, the instrument is eligible for inclusion in the Level 2 BHQLA category under Basel III. This means banks can hold it to meet liquidity coverage ratio requirements. It also means the instrument can be pledged as collateral in repo markets, posted as margin at clearinghouses, and potentially accepted at central bank discount windows. The Federal Reserve has not yet confirmed whether it will accept data-backed instruments at the discount window, but the language in the BIS framework suggests coordination. The framework explicitly references alignment with central bank collateral frameworks in major jurisdictions. The European Central Bank has been more explicit. In a December 2025 speech, ECB Executive Board member Isabel Schnabel stated that the Euro system is exploring the feasibility of accepting certain digital collateral instruments, subject to rigorous risk assessment. The infrastructure is operational. The first data-backed repo transaction occurred in October 2025. The counterparties were a U.S. money market fund and a European bank. The collateral was a tokenized instrument backed by anonymized geolocation data from a ride-sharing platform. The haircut was 25%. The transaction settled in 2 hours. The market is live.
Historical anchor. The precedent and the difference.
This is not the first time the financial system has expanded the definition of collateral in response to a shortage. In 2008, the Federal Reserve accepted mortgage-backed securities as collateral under emergency lending facilities. The securities were toxic. The Fed knew it, but the alternative was systemic collapse. The Fed took $1.3 trillion in MBS onto its balance sheet. It held them for a decade. In 2020, the Fed went further. It accepted corporate bonds. It accepted ETFs. It even accepted indirectly fallen angels, bonds that had lost investment-grade status. The logic was the same: prevent a liquidity freeze by expanding the set of acceptable collateral. But there is a difference this time. Mortgage-backed securities were backed by physical assets, homes. Corporate bonds were backed by cash flows from productive enterprises. Even the most exotic CDOs of the 2000s were ultimately tied to something tangible. Data-backed instruments are different. They are backed by behavior. And behavior is not a fixed asset. It is probabilistic. It is manipulable. It is subject to platform policy, regulatory change, and user exodus. Consider the risk vectors. Regulatory risk. If the European Union bans behavioral advertising under an expanded interpretation of GDPR, the cash flows collapse. The collateral becomes worthless. Overnight, platform risk. If a social media company loses 30% of its user base due to a competitor or a scandal, the predictive model breaks. The revenue forecast fails. The instrument defaults. Systemic feedback risk. If banks hold data-backed collateral and that collateral loses value, banks face margin calls. To meet those calls, they sell other assets. Asset prices fall. Collateral values fall further. The loop accelerates. This is not hypothetical. In March 2023, the collapse of SVB was triggered by a loss of confidence in the value of long-duration treasuries. Treasuries are the safest asset in the world. And yet when confidence broke, the collateral failed. Now imagine that dynamic with an asset class that is 7 years old, poorly understood, and backed by the attention span of smartphone users. The fragility is structural.
The system fights back. Regulatory response and new risks.
The regulators are aware of the risks. They are attempting to contain them. In January 2026, the Financial Stability Oversight Council, FSOC, designated data-backed securities as a potential systemic risk and recommended enhanced supervision. The recommendation includes stress testing, concentration limits, and mandatory disclosure of underlying data sources. But the recommendation is not binding, and the industry is moving faster than the rulemaking process. In December 2025, the International Swaps and Derivatives Association, ISDA, published a standard contract for data-backed collateral swaps. The contract includes clauses for data flow interruption events and regulatory prohibition triggers, but it also includes a clause that allows counterparties to substitute alternative collateral in the event of a data flow failure. The substitution clause creates a new risk. If a data-backed instrument fails, the counterparty can replace it with another data-backed instrument. The system does not de-risk, it re-risks. There is also a political dimension. In February 2026, a bipartisan group of U.S. senators introduced the Digital Collateral Transparency Act. The bill would require any institution accepting data-backed collateral to disclose the nature of the underlying data, the identity of the platform providing it, and the methodology used to value it. The bill has 12 co-sponsors. It has not been scheduled for a vote. Meanwhile, the market is growing. As of February 2026, the notional value of outstanding data-backed instruments is estimated at $340 billion. That is small relative to the $24 trillion Treasury market, but it is growing at 40% per quarter. The system is not fighting back, it is adapting. An adaptation in this context means embedding the risk deeper into the infrastructure.
Actionable insight. Analytical positioning.
This is not financial advice. This is analytical positioning for individuals operating in a system where the collateral base is shifting beneath the surface. First, understand your exposure. If you hold deposits at a bank, that bank holds collateral. If that collateral includes data-backed instruments, your deposits are indirectly exposed to platform risk, regulatory risk, and behavioral volatility. You will not be told. Banks are not required to disclose the composition of their HQLA portfolios to retail depositors, but you can infer. If your bank is a global systemically important bank, GSIB, it is almost certainly experimenting with alternative collateral. If your bank has a large derivatives book, it is facing collateral pressure. If your bank has publicly discussed collateral optimization, it is in the market. Second, diversify your liquidity. The lesson of March 2023 was not that banks are unsafe. It was that concentrated liquidity in a single institution is fragile. If you hold more than the FDIC insurance limit, $250,000, in a single account, you are taking institutional risk. Consider spreading liquidity across multiple institutions, including credit unions, which are subject to different capital rules, and non-bank platforms, which are not part of the collateral system. Third, monitor the regulatory calendar. The next inflection point is June 2026. That is when the Basel III Endgame rules are scheduled to take effect in the United States. Those rules will increase the capital requirements for large banks and tighten the definition of HQLA. If data-backed instruments are excluded from HQLA under the final rule, the market will collapse. If they are included, the market will explode. The comment period closed in January 2026. The final rule has not been published. Watch for it. Fourth, recognize the second-order effects. If data becomes collateral, platforms have an incentive to maximize data extraction. Privacy settings will tighten in appearance but loosen in practice. Terms of service will change, data retention periods will extend. The economic value of your behavioral data will increase and the platforms will capture it. You will not be compensated. You will be collateralized.
Final verdict. 4 structural truths.
Truth 1. The collateral shortage is real. The global financial system is built on leverage. Leverage requires collateral. The supply of traditional safe assets has not kept pace with the growth of leverage. The gap is $4.7 trillion and widening. Something will fill it. Truth 2. Data is the most abundant resource in the digital economy. Every search, every click, every swipe generates data. That data is collected, stored, and monetized. It is the largest untapped reserve of economic value in the world. It was inevitable that finance would find a way to collateralize it. Truth 3. The risk is not in the innovation. The risk is in the speed. Mortgage-backed securities existed for decades before they caused a crisis. The crisis came when issuance accelerated, standards eroded, and the instruments were embedded in the core of the financial system. Data-backed instruments are following the same path, but faster. Truth 4. The system will not collapse, it will mutate. The 2008 crisis did not end securitization. It changed it. The 2020 crisis did not end central bank intervention. It normalized it. This crisis, when it comes, will not end data collateralization. It will regulate it, restructure it, and make it permanent. The question is not whether your data will be used as collateral. The question is what happens when that collateral fails.
The 6-month horizon.
In 6 months, one of two things will happen. Either the Basel III Endgame rules will exclude data-backed instruments from the HQLA framework, and the market will freeze. Banks will face a collateral shortfall. Repo rates will spike. Liquidity will tighten. The Federal Reserve will intervene again with another emergency facility. And the cycle will repeat, or the rules will include data-backed instruments, and the market will scale. Within 18 months, data collateral will represent 10% of the global HQLA base. Within 3 years, it will be systemic. And the next crisis will not be about subprime mortgages or sovereign debt. It will be about the stability of human behavior as a financial asset. The infrastructure is built. The contracts are written. The first transactions have settled. You are no longer the customer. You are the reserve.